Welcome to Market Mondays. It's the 27th of November. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Singapore. There's been a lot of buzzwords that has been trending around for the last few weeks. Green shoots, soft landing, rate cuts. A lot of this is giving a boost to the US market, and the VIX, which measures market volatility, as well as it's kind of used as a fear gauge. It's actually at its lowest since January 2020. So what does this mean for the Asian markets and specifically for Singapore? Are we seeing our own green shoots? So that's something that we're going to be talking about today. So first up, we're going to have Hak Bin Chua, our head of macroeconomics, who's going to be talking about the prospects for Singapore's economy as well as inflation going into next year. Then we are going to go into the tech sector, where we have Jarek, who's going to be talking about some of the green shoots he's seeing in this sector. And then finally, we're going to go across the causeway to Malaysia, where we're going to talk about a few high conviction picks where we are seeing, again, some green shoots. But first, let's look at the market movers. The US was all green going into Thanksgiving weekend. A lot of optimism on soft landing and rate cuts in 2024. But this didn't translate into optimism in Asia. We actually saw Hong Kong down about 2 percentage points, as well as China down about 0.7% as well. So the markets are not fully convinced of the stimulus measures that China has been putting on. Southeast Asia was also generally in the red, except for KLCI, which is seeing a strong third quarter result season, which we haven't experienced in a while. Now, I think now is a good time to bring Hak Bin on the show. Hak Bin, welcome to Market Mondays.
Hey, hi, morning, Thilan.
Now, I want to ask, in Singapore's core inflation, it kind of broke its 8-month easing streak in October, and third quarter GDP came in better than estimates as well. Now, let's start with inflation, Hak Bin. Where core inflation was up to 3.3%. Was this a surprise, and what's driving this?
Yeah, I think it was a bit of a surprise. I think core inflation has been sliding down for most of the year. So I think there's 3 parts to it. One was the pickup in services inflation, picked up to 3.4%. That's actually led by the holiday expenses. So I guess Singaporeans are still willing to spend big on holidays. Second is the retail items, surprisingly rose 1.6% versus 0.9% September. And then electricity, gas, which was kind of expected because Singapore Power raises electricity tariffs by quite a bit. Does it every quarter, and there's a bit of a lag. So the next one will probably be a downward shift. Headline inflation as well rose, but that's because of the COE premiums actually going up in November. But bear in mind, that's going to plunge it went up in October, but it's going to plunge in November because of the increase and bringing forward of the supply. So we did expect inflation to have a harder time falling from this time onwards. We're expecting core inflation to remain sticky for next year. So chances are it'll still cool, but I suspect it will still be above the MES comfort zone.
Right. And in light of this, have you made any adjustment forecasts for inflation for this year or next year?
No change to core inflation forecast, which averaged 4.8%, driven largely by the high levels that we saw in the first half. 2.8% next year. So we're looking at 3% core inflation by the end of the year, cooling down slightly. And that's still above the historical kind of comfort zones. So we have to bear in mind there are a couple of price increases that's coming out. The GST is going up. Some of the public administration prices are going up, like water, public transport. And of course, the labor market is still pretty tight in Singapore. So that's probably going to be sticky. The headline inflation we lowered actually, and we lowered because private transport is quite a big segment of the headline inflation. And I think the COE supply is increasing by 20-30% next year. And that should reduce the COE premiums. But bear in mind that the MAS focuses largely on the core inflation. That's still pretty sticky. And I think that's probably why they will probably maintain the appreciation bias in January.
Hopefully, the COE is coming down. It'll bring some Christmas cheer to some people as they look for new cars. Now, Hagwin, third quarter GDP actually came in stronger than expected. And today, I think we're focusing a lot on these green shoots. What are the underlying drivers for that?
So the kicker is, for the third quarter GDP itself, it was largely the services side that surprised a bit on the upside. For us, I guess the finance and insurance kind of stood out because it actually returned back to positive growth for the first time since about a year ago, led by fund management and activities auxiliary to financial services. This despite, I think, slower sales for insurance products as well as slowing loan growth. Accommodation was also a bright spot. Despite having done very well, it was still holding up close to 13%, boosted by tourist arrivals in the third quarter. In terms of levels, tourism is roughly about 77% of pre-pandemic levels. So just some legs to go, I guess, before kind of normalizing to those pre-pandemic levels. I guess good encouraging news for the October data is that manufacturing exports, right? So all of it now has turned positive, for the first time since over a year ago. So manufacturing growth is positive, export growth is positive, PMI Singapore is also positive. So I think that's pretty encouraging. It suggests that fourth quarter growth could actually comfortably exceed 2% by our estimates, and as some of these trade-related services also pick up.
Right. Okay. And so how are you kind of thinking about growth going into 2024? I know you upgraded your 2023 GDP forecast. So obviously, and you're keeping your growth into 2024, but off a higher base. So can you give us a bit of color on what's going to drive that?
So, this year was a bit of a divergence in Singapore, right? Services did very well because we had this revenge spending and tourism coming back. But manufacturing was terrible in the first 3 quarters. It's actually subtracted from growth. Now that the green shoots are kind of showing up for manufacturing and exports, and we think that that's probably going to be sustained, into at least the first 6 months of next year. That should be supportive for growth. So growth will become a bit more balanced, a bit more even, and that should kick up and support growth. So we're looking at 2.2% growth for next year. So that's, I think, quite a decent range. The government is looking at 1 to 3%, so we're in the higher part of that range. But I would still argue that probably there could be risks on the upside if manufacturing kicks off a lot more strongly. Services growth, we are expecting to shift in terms of the components. All those domestic-oriented hospitality, travel services will still continue to grow, but at a much slower pace. So, some of this revenge spending should dissipate. But some of the trade-related services like wholesale trade, transport and storage, and actually financial services should also pick up from the contractions that we saw in the first half, and that would also support growth. So some shifting of winners and losers between sectors.
Got it. Thank you, Hagwin, for joining us and taking us through our macro views. Now, let us turn to equities, and especially, we're talking about growth and talking about, going from low expectations to high expectations. And I think one sector that has been had a lot of low expectations in 2023 has been the tech manufacturing sector. And I think Jarik's had a very tough time for most of this year, answering investors' questions. But, he's been using a lot of phrases like hitting rock bottom, recovery on track to describe this sector, since the third quarter results. So, Jarik, welcome to the show. I saw your very bullish call on Frencken, where you've increased your target price to 139 from 127 Sing dollars. What's driving your optimism?
Hi, Thilang. Thanks for having me. I think for Frencken, we sort of said that 1Q was the bottom, and I think that for 2Q and 3Q they delivered Q-on-Q growth subsequently in even in the third quarter, and also in the fourth quarter we do think that with revenue picking up, if you look at third quarter revenue pick up 3% Q-on-Q, and we do think that fourth quarter revenue will pick up as well, mainly because in the US, I mean in Asia, the Asia semicon segment has stabilized, and it's actually customers are actually ordering more, especially from its key customer in Asia, which is Applied Materials. So that will help to boost the semicon revenue segment, which will actually contribute a lot to the bottom line because of its good margins for Frencken. And going forward, for FY24, we do think that FY24 will be a better year than FY23, because for FY23, a lot of these semicon players, as well as even not just semicon but other sectors, their inventory levels are all very high because they stock up during COVID, right? And because of the supply chain issues. And then in 2023, we see a drop in demand across the board. So basically, with this high inventory levels going down in 2023, we don't think that they will come to a normalized level in first half after first during first half of after first half of 2024, and orders as a whole should actually increase for FY24 as compared to FY23. And if you look at Frencken, basically, I think management has been quite bullish as well. They guided for quite a good outlook, of course, depending on certain projects. But if you look at the MPIs wise, they have a lot of MPIs that are in the works now. They are not even looking for other new customers, because if the MPIs do go ramp up to a good volume next year, their capacity will be full. So there's the chance that actually Frencken can go back to the 2021, 2022 peak levels of production. And that is actually the only one that I can see in Singapore, guiding for that, if things go well. Yeah.
Right. And is that why you have Franken as your top pick in the sector, or is there any other differentiating factors as well?
Yes. Yes, correct. Also, I mean, partially, yes, that, as well as also if you look at, back in 2021, 2022, when the semicon boomed, Franken's beta towards semicon positiveness is very strong. So I think after COVID, the low was about 40 plus cents. And then, during the boom, the peak was 250. So the beta is about 5 to 6 times, I mean, in terms of the share price upside, as compared to that of UMS, which is from 80 cents to $1 plus. And then AEM also did quite fairly well, but AEM, I think, doubled. Yeah. So Franken has a very high beta towards semicon revenue, and we do think that if there's a pickup in semicon next year, Franken share price should react positively to that. Yeah.
Okay, got it. Now, another stock, I mean, you did speak about it last week, but since then you've hiked Venture's target price by about 10%. The stock's actually still down about 26% in the past 12 months. So again, what's kind of driving your thought process here?
I mean, I covered Franken for a long time, and I think that this current share price level has not been seen for quite a while. So with the outlook now being more positive, we do think that it's trading way below its historical 10-year PE range, mean of about 16 times. Now it's trading close to about 14 times this year, 12 plus times next year. And with a brighter outlook, I mean, if you look at this company, they have always outperformed their peers. Your typical EMS players, even like Electronics and the big guys, their net margins are about 2-3%, and Venture is maintaining at around 9%, even with a revenue drop this year, which shows that the management is very good at cost management, and also they are getting higher margins because they have more design content in their projects, which also increase the reliance of their customers on Venture. So I think that there's a lot of good merit on this company, and also if its net cash position close to a B, dividends could be easily sustainable. So I think Venture has always stressed that they are not going to give you more dividends or less dividends when they do badly or do worse, but they'll give you sustainable dividends. And we expect the base dividends to be about 75 cents, which represents close to a 6% yield. And if they do better next year, they could actually give more. So we do think that at this level, it's trading way below the 10-year mean. Outlook is better, not fantastic, but better. So FY24 should be better than FY23. And you still have a 6% yield, on the back of that coming, in February after their year-end results. We think that the downside is actually quite muted, but your upside, if they do well, could actually go much higher. So for us, we do think that this is one of the good stocks that we like now, and that's why we also up my target price because of the better outlook. We do think that as the PE range is about is about 16 times, I only increase it to 15 times, so it's still below the 10-year historical average. Yeah, so we do think that that's why I up my target price because of the good outlook as well. Yeah.
Okay, so downside limited, 24 can be better than 23. Strong management, and shareholders are paid about 6% dividend yield while they wait. I think and the chart actually looks quite compelling as well. So please do have a look at Venture. Now, I do want to kind of highlight our technicals this week, and echoing what Jarek is saying, our technical chartist Nick is featuring Frencken as one of his top picks for technicals. You already seen Frencken having gained about 10% since he put out his first call, but he thinks that the last week's gain will kind of kickstart a new upgrade cycle for the stock. So he's reiterating his buy with a higher target price as well. So that's something to watch out for. The other stock he's highlighting this week is Capital and Investment, CLI. The stock's been on a bit of a downtrend, but he thinks that downtrend is now almost at its tail end, and you will start to see a bit of a gap up coming through. So on both RSI and MACD readings as well, the stock's looking quite good. So he's expecting more momentum to start coming through over the next few weeks. So that's something to watch out for. Right. Let's change pace and go across the causeway. We have our gaming and airlines analyst Samuel Yin. He's made two bold calls this week, one on Genting and one on AirAsia X. So he can't join the call today, but let me quickly take you through some of the key highlights. Let's start with Genting it's had its best quarterly results in third quarter since the fourth quarter of 2019. Beat expectations handily. And a lot of that actually came from Genting Singapore, where the VIP volumes have been a lot stronger than what anyone expected. And we also did see support coming from Mesa One, their IPP, the power producers' contribution as well. But it's not an isolated upside. If you actually look at most of the other segments as well, you are seeing quite a bit of bright outlook as well. Resorts World in Las Vegas have finally found its footing, reporting a record EBITDA of around $52 million US. And the Malaysian operations are seeing a more local footfall. And what's more importantly is that the locals are spending more per person than before. So all of this has led Samuel to actually increase his EPS forecast for 2023 to 2025 by around 11 to 37%. He's also raised his target price to 549 ringgit as well. So quite an interesting stock to look at. Despite the fact that it's had a bit of a run up from its November bottom. Now, the other stock he's highlighting is AirAsia X. Here, the numbers were a little bit disappointing, but if you drill it down a little bit deeper, you see that a lot of the disappointment came from high jet fuel prices. Third quarter jet fuel prices were around $130 US a barrel. It's already down to about $102 a barrel. So you should start to see some of that benefits coming through in the fourth quarter as well as going into 2024. He's also expecting fourth quarter 23 fares to peak as with historical trends as well. Plus, for the first time, you'll start to see AirAsia ex Thailand also coming in with meaningful contributions to the group as well next year. So if you look at our own earnings forecast, we're expecting 2024 earnings to grow 4x versus 2023. So big moves there. And at the same time, Bursa Malaysia had a PN17 classification on the stock. Now, this is a classification that Bursa gives for companies on distress. Now, they've lifted that. And what this means is quite a few institutional investors who couldn't have participated in this stock now can. Target price of 340 ringgit, which is about a 62% upside, with a buy rating as well. So please do take a look at AirAsia X on Bursa as well. We've got quite a few events coming up this week. We've got bank lending rates coming out on the 30th. We've got the PMI readings coming out on the 4th of December. Remember, Hakbin talked about PMI being quite positive in last month, so something to watch out for this month as well. Unemployment rate comes out on the 14th, and Nodex numbers, export numbers are coming out on the 15th. Apart from that, also want to highlight a few events that we are having in the next few weeks. If you can have the event slide on. We got a virtual meeting with the Siam Wellness Group on the 29th of November, and Japan autos and auto parts sector outlook. We've seen Nikkei continuing to outperform this month as well, so something to watch out for with our partners Mizuho Securities as well. Both are invitation only events, so please do speak to your salesperson if you'd like an invite. With that, unfortunately, we are out of time. I do see some questions, mostly on China. One thing I will promise is that we, over the next week or so, one of our next Market Mondays, we will have a show mostly focused on North Asia and China from the currency point of view, as well as from economics point of view and a stock point of view as well. So please do keep joining us, and please do do let other investors, your friends and family know to join us as well every Monday. Thank you, and have a profitable trading week.